MBA ASAP. MBA ASAP. Hello and welcome to another episode of MBA ASAP, where we explore business skills and knowledge so you can level up your expertise and learn skill sets that will make you more valuable at your job and career, or help you start something on the side, a little side hustle, or let you quit your job and start your own business. I'm your host, John Cousins. Let's get started. Hey, and welcome to MBA ASAP. Today we're going to talk about forward-looking finance, the time value of money. And what we mean by the time value of money is that $1 today is worth more than $1 in the future. And the relationship between the two, between present value and future value, is the discount rate or an interest rate. For example, if you had $1 today and say you could put it into the bank and collect 10% interest on it, well, what would that be worth in a year? Well, it's going to be worth $1.10, right? It'll be worth, you'll still have the same dollar, but you also have 10 cents of interest that you collected for that time. So if you can get take $1 today and make it be worth $1.10 in a year, then if you were offered the opportunity to get $1 a year from now, you'd have to discount that to see what it would be worth in today's dollars, right? So you'd have to say, well, if I could take $1 today and make it worth $1.10 in a year, what would $1 a year from now be worth to me today? And without doing the calculation, somewhere, in the 92 cents. And what it would mean was if you took that 92 cents and put that in the bank today at 10% interest, a year from now it would be worth $1. So that's the relationship basically between present value and future value. And that's what we're going to talk about. It's basically the old adage, a bird in the hand is worth two in the bush. The two in the bush represents the unknowns, the uncertainty of what you're going to get in the future. And that has to do with the risk. And a lot of times what we do, we price that risk, and that's part of the interest rate or the discount rate as well. So we have a couple of segments here, and let's get into the first one on the time value of money so that we can get that concept pretty solid in our heads. Then I'll come back, talk to you some more, and then we'll go into another concept, discounting cash flows. And that's basically taking that concept of the time value of money and applying it to cash flows coming into the future. And this technique is how bonds are priced, how stocks are priced. We're looking at what are the revenues, the anticipated revenues in the future, and pulling them all back to today's dollars and saying that's the present value of that stream of cash flows. So the time value of money is the technique also for valuing projects. For example, say we were thinking about building a new power plant. We were an electric company, a utility company. And say it was going to be a nuclear power plant and it was going to cost $1 billion to build. Well, we would look at what are the anticipated revenues for the next umpteen years from that power plant, pull all those anticipated revenues back to the present, and see what that present value sum of all those future cash flow streams would be. So say if it came out to be $1.5 billion, then we would think, okay, this project is worth doing, right? We spend $1 billion today, and we anticipate getting the present value over time of $1.5 billion. So it's net good as a project to the tune of $500 million in this case. That concept is called net present value. And in the next episode, that's what we're going to get into is actually net present value. Once we get these concepts of the time value of money and discounting cash flows, once we get those solid, then we'll go and look at the net present value. And that's really the gold standard of valuing any type of income-producing assets, companies, bonds, projects. It's really the gold standard. That is the key tool of finance. So I just want to give you an idea of where we're going with this and what you can anticipate. So let's get down to it now. Let's look at the time value of money, and then I'll catch up with you on the other side of this talk to you a little bit more, and then we'll go into discounting cash flows. Catch you on the other side. The time value of money. There are two sets of data that we use in corporate finance: retrospective and prospective. Retrospective data is compiled in financial statements. These represent the historical performance of an enterprise and can be analyzed, compared, and extrapolated. Ratios are the tools of financial statement analysis, and we just discussed them. Prospective data is compiled in financial projections. These represent management's forecast of how the enterprise will perform in the future. These projections can be analyzed, risk-adjusted, and a present value of those future cash flows can be calculated. We will now get into the forward-looking aspects of finance with the concept of the time value of money, or TVM. Time is money, literally. If there is a prospect of receiving a certain sum, then the sooner you receive it, the more it is worth. Interest rates describe this relationship between present value and future value. This is the fundamental concept of finance. We will explore this relationship between present and future value from different angles, and I will phrase it in different ways in order to let it sink in. The time value of money represents the conceptual basis of finance. This is the underlying principle of how banks function, how stocks and bonds are priced, how assets and companies are valued, how projects are analyzed, and how you should think about the nature and function of money. A bird in the hand is worth two in the bush. Receiving money today is worth more than getting the same amount in the future. And the value of the prospect of receiving money diminishes the further into the future the promise to deliver that money. The rate at which the value of $1 in the future decreases relative to $1 today is inversely proportional to the rate at which $1 invested today will increase in the future. Take a second to let that point sink in. The future and the present value are two sides of the same coin, pun intended, and they are related to each other by the interest rate. The concept of the time value of money explains why interest is paid or earned. Interest, whether on a bank deposit or debt, compensates the depositor or lender for the time value of money. Risk has to do with the uncertainty of being repaid, and interest rates reflect this level of uncertainty or risk. One of the reasons credit cards have such a high interest rate is that the risk of other people defaulting on their balance is baked into the rate. The time value of money also underlies investment. Investing is about managing risk versus return. An investor is willing to forego spending their money now if they expect a favorable return on their investment in the future. The return required is related to the perceived risk of getting one's money back in the future. The higher the perceived risk, the higher the required rate of return. An investor is willing to part with their precious capital when their greed overcomes their fear, where the expected return exceeds the perceived risk. A history lesson. The concept of the time value of money dates back to the 1500s. Martin de Azpilicueta of the School of Salamanca, December 13, 1491 to June 1, 1586, also known as Dr. Navarrese, was an important Basque theologian and an early economist and the first person to develop the monetarist theory. He invented the mathematical concept of the time value of money. It's an idea that's about 500 years old. Discounting cash flows. The core of corporate finance is calculating the present value of future cash flows. This concept is based on the time value of money. A company is essentially an entity that generates cash flows each year into the future. The trick is estimating those future cash flows and how much they might grow or shrink and what the risks are to realizing i.e. receiving them. It's difficult to peer into the fog of the future. This is where you have to polish your crystal ball and do some deep analysis of the business, its markets, and competitors. All this information is compiled into a spreadsheet of financial projections, and the bottom line represents the future cash flows in each year. These are discounted back to present value at a discount rate that takes into account what similar investments, which are just streams of expected cash flows, are priced at in the market, and any and all risks specific to the particular enterprise or asset we are contemplating buying or selling. This is the basic concept of valuation. Valuation is an estimate of something's worth. Something's worth can be set at auction where people bid and the highest bidder wins. But how do bidders know how much to bid and how much is too much? For income-producing assets like stocks, it's the present value of the future cash flows, the expected future cash flows. The stock market is essentially an auction where investors place bids, basically how much they are willing to pay for a stock, and asks how much an investor is willing to sell it for. When a bid and an ask match, a transaction happens and a new price is set for that stock. Companies and assets, and even startups that don't have any revenues yet, are valued using this principle. This technique of calculating the present value of a stream of cash flows becomes essential when trying to value startups that have no revenue history or assets, or companies that are predicted to grow rapidly. In these cases, you can't rely on past performance and history in order to come up with a value based on a price-earnings ratio or the value of the existing assets. DCF, discounted cash flows, is the technique favored by investment bankers, venture capitalists, private equity, hedge funds, and savvy investors, banks and credit analysts, and CFOs. It's not difficult to understand, and you will be amazed how useful and powerful it can be. Discounting cash flows, present value and future value. $100 invested for 1 year, earning 5% interest, will be worth $1.05 after 1 year. Therefore, $100 paid now and $105 paid exactly 1 year later both have the same value to a recipient who expects a 5% return. That is, $100 invested for 1 year at 5% has a future value of $105. This assumes that inflation is 0% and doesn't contribute to eroding the value. The equation in this case looks like this. 105 equals 100 times, in parentheses, 1 plus 0.05. The general formula for solving the future value is the future value equals the present value times 1 plus the interest rate, in parentheses, where FV is the future value, PV is the present value. The reciprocal formula to solve for present value juggles the terms using basic algebra and restates the relationship as the present value equals the future value divided by 1 plus the interest rate in parentheses. It simply puts the 1 plus the interest rate term on the other side of the equation to solve for present value by dividing both sides by the 1 plus the interest rate. Now, if this is confusing to you, just replace the 1 plus r for a second by the term x. So that would be future value equals present value times x. Now, if you divide both sides by x, you get future value divided by x equals present value divided by x over x, which equals 1. So that term goes away on that side. Now, if you just then again replace the x with the 1 plus r, you see how we derived the equation. So take a moment and make sure you really understand this because it's the basis of project finance and asset valuation. This is the formula we use to calculate future cash flows as a present value. And if this is confusing, get a copy of the book and look at it in print. You'll understand it right away. So this concept is used to calculate the present value today of a projected stream of income in the future. Sit with that concept for a while until these concepts really are clear to you, because this is the core concept of finance. Basically, present value equals future value divided by 1 plus the interest rate. Now, the general formula puts that 1 plus the interest rate to the exponent of the year in which it is going to be received. So all the terms are familiar to us so far, except for the exponent n, which represents the particular year in which it's due. So for example, if the future value was due in year 2, then n would be 2. If the future value was due in year 5, then n would be 5. So basically we have the present value is the future value divided by, in parentheses, 1 plus the interest rate, and that taken to the exponent n, the year. The further out in time, the bigger n is, and the more discounting is applied to the future value. It's as simple as that. So when there are a stream of future values, these cash flows are all discounted back to the present value based on the year they're coming in, and then all those are added together. And this sum of all those added together is the present value of that entire income stream. That's the present value of future cash flows. Well, that'll do it for this segment of MBA ASAP. The third segment will be using those present value calculations to investigate the gold standard tools of financial analysis, which are net present value and internal rate of return. So stay tuned. Take care. I hope you liked this episode. Please email me and give me your comments and questions, anything that wasn't clear so I could clarify it. And my email is john.cousins@mba-asap.com. Take care. Have a great rest of your day. Peace. MBA ASAP. MBA ASAP.